Matt, you strike me as a financially mature guy. Would you consider yourself financially mature?
What does financial maturity mean?
You don't know. Well, glad you stumbled across another episode of Builders, Budgets, and Beers, where we're joined with Luke Holcomb, VP at Apparatus Bookkeeping. They do all construction centric accounting specifically for builders. And he's just going to drop a knowledge bomb on you, discussing financial maturity in construction businesses, going all the way from the groundwork phase, framework phase, the expansion phase, and then the strategic mastery phase. There's a lot of really good content in here. There was actually some like mind-blowing moments for me, just even how I associate successful businesses to revenue and how it's really quite the opposite. If this is something you want to dig into, you should keep listening.
All right, let's get into it.
And we are here welcomed, joined with our good friend, Luke Holcomb from Apparatus. Luke, thanks for jumping on.
Yeah, it's a pleasure.
Really excited to dive into today's episode with you and talking about financial maturity. But before we do, give us a 1 minute background on yourself, on Apparatus. Let the audience know who's going to be educating them today.
Yeah, so I was a guy that liked to be outside a bunch when I was a kid, and because of that, I kind of gravitated towards framing construction and like the guys that I knew, and I liked math also. So, if you've ever framed a house, there's actually a fair amount of math involved in that, and as you're figuring stairs, rafters, whatever, and I just really enjoyed it. Kept working my way up, ended up running other people's companies, and then started my own, sold one, did a few different things, some stuff in real estate, and then I met up with Apparatus, and I was in the middle of a situation where I was just looking for that next thing. I wanted to work remotely. This was like way before the pandemic, and people, if you're gonna be in the construction industry, people kind of wanted you to be there, right? And I wanted something that was more flexible than that, and so I met up with Apparatus and started with them, kind of onboarding clients, figuring out hey, what's working, what's not working, and creating processes. I've always been like a big process oriented guy, and so creating processes that improved our service enabled us to serve bigger and better clients. And now I'm the vice president of operations for Apparatus. I oversee all the bookkeeping.
Look at you.
There you go.
I oversee all the bookkeeping teams and kind of like what our processes are internally, how we deliver our service, what the best practices are. And then because of my experience in the construction industry, I also jump in as like a subject matter expert if our clients are trying to solve a problem around, how they're going to invoice or for a certain type of project, how they're going to plan financially for, an opportunity that they have, things like that. So.
Yeah.
Was there ever any advice on like what does the spacing between our rafters have to be? Would you ever jump in there, or was it always construction accounting?
No one asks, but it's 14 3/8 inches. I still got it.
Yeah, I still got it.
Just for the
rafters now, that's accounting that each one is 1.5 inches. So we're 16-inch on center.
Reece, just for the audience, that Apparatus, for those who are listening,
yes,
is one of the most well-known kind of premier construction-focused accounting and bookkeeping firms. So
yes,
Luke knows rafters, and he also knows books, as you may have gathered from his description there. Just wanted to make that clear.
That's right. Construction-centric accounting. And that's why it's great to have you on here, Luke, to, again, talk about financial maturity of the business and the stages that they go through. Just for the audience, when we say financial maturity, give us a little definition there for what that really means.
Yeah, so I think it's maturity in the way you think of it in any other way, right? Like when you're if you relate it to like when you're young or whatever, you have a certain maturity level. What you focus on is going to kind of be dictated by that. What's going to get you in trouble is going to be dictated by that. When you get older, like, what I'm focused on is different at my age, and what's going to get me in trouble is a lot different. And so the financial maturity of a construction company is not really any different, right? It's
Mhm.
It's going to kind of dictate where you're at in the process. I mean, everyone wants to get to that place where you like have a company that you can either pass on as like a legacy company, or you can sell it, that it has value outside of yourself. But no one gets there overnight. No one starts there, right? And so there's kind of stages to get to that point.
Love it.
So you think there are 4 stages of financial maturity for construction companies, right? That's what we're talking about today.
Yeah, and there's some flexibility within that, and I think especially when you get to the 4th stage, I think folks who are anywhere near that can recognize like, oh, I'll have some of those things, but not all of them, and so things are fluid. But yeah, I broke it down into kind of 4 buckets that I think do a good job of summarizing that.
What are the buckets?
Yeah. So I have some super sweet names for them. So Stage 1, I call the groundwork. It's just getting started, right?
Okay.
Stage 2 would be framework, where you're really starting to kind of build systems, processes, the structure that you're going to need. Stage 3 would be the expansion phase. So like really, taking what you've created the capacity for and maximizing that capacity. And then the 4th and final stage would be strategic mastery. So you're really looking at, how you're going to move in a marketplace and using your financials as a guide for that at that point. So
love it. Groundwork, framework, expansion, strategic
mastery.
Mastery. Okay, great. Yeah. Go ahead and jump into the first, the groundwork, and why that's obviously it's the starting point, but why it's so critical.
Right. Well, so groundwork, and kind of all goes back to who you're going to see in this group of people. I mean, I'm sure, Reece, I know you've been around the construction industry for a long time. I think when you have someone in this stage, they're probably a project manager for a pretty large builder, and they're like, you know what, I can do this, and I'm going to. Yep. And they kick out on their own, and they get going. And a lot of times what they're going to be focused on is going to be based on what their experience is to that date, right? So they're going to be focused mostly on project finances. And so they didn't do this because they were a bad project manager. They did this because they were a good project manager. So they're really focused on the project and all the things that go along with that. They'll probably have a super accurate, budgeted cost versus actual cost. They'll, they know how to run that project finance side. Things that they're probably not going to be very familiar with are things like the balance sheet, working capital. Certainly, they wouldn't have anything like that. I would say the biggest risk that they're going to have is making sure that they have enough profit at the end of the year to cover their overhead, right? So being focused, if you come from a big builder and you're like, well, we're doing cost plus 15%, and we're making money and they're paying my salary and everything's working out great. And then you go into running your own shop and you're doing cost plus 15%. Well, now all of a sudden you're like, well, I need a new truck. I needed this. I need that. I need a back office staff. I need, all these things. And what I think your blind spot there is going to be that there's a lot more projects supporting those overhead needs in that big company, and that you just don't have. You don't have that many projects running. And so understanding how individual projects fit into the bigger picture of a company is something they typically don't have a lot of experience with. Even with, we've met people that came out of like pretty big production builders. Like they would be over whole neighborhoods as project manager, and still like the idea of a balance sheet or how much profit they have to make in a year to cover overhead really wasn't something they'd ever interacted with before.
So groundwork. So it's kind of interesting. So you're saying the first stage. I was expecting the first stage to be, below this, right? Like not even job costing, right? You're just like getting started with the idea of job cost. You're skipping. So this is an advanced podcast. We're starting with project financials dialed in. Okay. Yeah. So we've got job costing dialed in. Okay, that's
and I should say that's where we meet most of our clients. I, if you aren't thinking that you need to know how much you spent on your projects, like you're probably not going to be a good fit for our company. And yeah, I would say we're looking at that level of maturity and up. So
Okay, got
Sure.
it.
Well,
Groundwork.
and I think that you made an interesting comment of like when you work for a bigger builder, you almost have like overhead centric projects. Is it safe to say that it's like you win on like at a certain point you win certain jobs and you're like, this is going to cover overhead and we're not looking to like really like squeeze a ton of like profit out of this? Or does it all just kind of blend together as you do hit that volume stride?
So that gets into kind of where you get to stage 2, right? Where you become
Okay.
aware of how, like, those are numbers. And that's the thing, like, a lot of this is, are you tracking your financials and are you using them correctly, right? And those are numbers you can get out of your accounting, right?
Mm-hmm.
So not only how much you need to sell over the course of the year, but how profitable that work needs to be, and you get to a point where how much you're producing, right? Because if you go sell a job for $300,000, but then it rains for 3 months and you don't get to do any work, well, guess what? Like, you're not taking in any money, but your overhead, your office rent doesn't stop, your cell phone bill doesn't stop, your truck payment doesn't stop.
Mm-hmm.
And so, you can get into issues there too. So stage 1, I think what those guys need to focus on to get out of stage 1 is make sure you like don't think you can get very far without real accounting, right? Um, get it in place now. You're a small company, and I think a lot of people tell themselves, especially when they're getting started, they say, "Hey, you know, I'll handle that when I'm bigger, or I'll fix that when I get bigger." And the reality is that if it's a small problem when you're a small company, well, guess what it's going to become when you're a big company. Now it's a big problem, right?
Mm-hmm.
And you just got to get that stuff out of the way now and fix it. Um, and
What
then
are
hope
those revenue thresholds? Sorry to cut you off, but when you say like small company, big company, where do you see that like groundwork to framework from a revenue benchmark standpoint, if there is one?
Yeah, I think it depends on the market, right? I mean, if you're in Colorado and
Mm-hmm.
you've been working for a builder and you're a project manager, you think you need to go out on your own and you're gonna, nail it. You might have an opening year of like 1.5 million in revenue and be
Right.
in groundwork. You like, that's the starting place. Um, I'm in Southeast Tennessee, so here it could be $600,000
Sure.
is the beginning of that. So it just really depends on where you're at and what types of projects you're doing too. Um, so yeah.
The
Okay.
groundwork is like, hey, I built a budget and I tracked the cost against it. Framework is I'm paying attention to my entire company's financials. You called it real accounting. Can you describe what you mean by real accounting? So framework is real accounting. What does that mean?
Yeah. Um, so you're using an accounting software, right? You're using QuickBooks. You're not coming to a company like Apparatus with a bunch of spreadsheets and saying, oh, I'm
Mhm.
pretty sure it's all there. You're like, no. Like, you're using, Sage. You're using QuickBooks Online. You're using some sort of reputable accounting software. You are, when you get into framework, that's where you're really starting to do your financial controls internally, right? So as a project manager, you're probably understand a lot of financial controls without realizing it, right? So you're like, oh, we get a bill on this day. You're just emulating what you did in your old job, right? You're like, we get a bill on this day, we input it, we approve it, we pay out on this day, right? Or then I submit for a draw and then we pay out, or whatever the case may be.
Mhm.
And so you're going to keep, those are financial controls, whether you realize it or not. Um, and so framework, you really build those out, hone them in, come up with standard processes that are going to work and are applied to everyone. And maybe now you have some employees now, so they have to turn in receipts if they want to keep using the company card, and you have things like that. You have a formal accountant who's going and doing like a closing process where they're reconciling your accounts. You're not, and this is kind of another problem that you'll see. And I'm sure you guys have run into this because you guys offer this pretty sweet software platform, but it kind of comes with a caveat of that you have to kind of have it together a little bit for it to be very useful for you. And in the construction industry, especially, and I'm sure it's like this other places, but it's easy to confuse, especially for a project manager who, his focus is, did we follow the change order process? Is the customer happy? Have I communicated these things? Did we do it to the engineer's specs? All these other items, are we going to pass inspection? Those are the things that they're focused on. They're not focused on how to do accounting or bookkeeping, and they really shouldn't be. It's a specialty, just like project management is a specialty, but they don't know how to manage that. And so it's really easy to see someone who has worked for construction companies and knows how to operate the QuickBooks software platform and confuse that for someone who knows how to do proper accounting and bookkeeping, right? And so you kind of get that situation, but that is something that you can deal with by going, just finding the right CPA and saying, hey, I need you to check up on this every 3 months or whatever, and you get that in place and you'll be in good shape. But those are the sorts of things you need to build with framework. And in framework, you may either you'll see people that made it through stage 1, they made it through groundwork and now they're in this situation. You may see people that were operation managers at other construction companies. And so now they're starting to see a company-wide P&L and they understand how the project profitability fits into that. But their blind spots are still going to be, they're at that point where they don't know what they don't know, right? They'll maybe they've learned a few things and that can give them some confidence, but that confidence is not really backed up by knowledge. And so even every day, the smartest accountants I know, when they come up against something, their first thought isn't, oh, I'm right and you're wrong. Their first thought is, maybe there's something I'm not realizing here. And then they do some digging. And for most of the people that I work with, like at the end of the day, they're like, no, I was right. Okay. But right. I think it's like a deep expertise where, you understand that there's maybe multiple ways to do things. And there's a lot of nuance to it, right? Think of the difference between a new guy on the construction site saying like, I need a worm drive. And, the very new guys will be like, I have no idea what you're talking about. And you're like, the saw. I need the skill saw, right? And then you get these old guys who are like, they'll get mad at you if they ask for a worm drive, but you bring a sidewinder out of the trailer, they're going to get mad at you. And then you have like the guys that are older than them that are just like, I don't care, man. Yeah, give me a saw, whatever. This is not what this one's called. It's called this, but this will work. Come on, let's go. Yeah. And accounting's like really no different than that as far as like layers of expertise. And so it's really easy to feel like you know more than you really do when you're in this stage. I think one of the big things that we see is that people confuse like their profit and loss statement for what's going to come out of their bank account, right? So a common thing we'll hear is they'll be like, well, it says I made $100,000 last year. Where, I don't have $100,000 in my bank account. And you're like, well, you bought some equipment that doesn't go on your profit and loss. And they're like, what? But I spent the money. You're like, it's an asset. It goes over here. It's like, it's kind of complicated. And so you need someone in your corner that understands that stuff and is willing to walk through it with you. And that's the only way you're going to get through that framework stage. So you're building, the structure of what it's going to be, and the rules that you're going to operate with, but then also you're starting to understand, more of the nuance of not everything's a skill saw or not everything's a worm drive or whatever, like there's some nuance when it comes to looking at these things. And this is like a really good time to bring on, we see people that are successful getting through this stage. They're either bringing on, they have a good construction specific CPA. They have someone guiding them, right? And so it could be a construction specific CPA. It could be an outside kind of fractional controller. It could be a business coach that understands finance, because there's business coaches that understand a lot of different things. But you really want to have one that understands finance, because you can get some that will coach you to sell as much as possible, and then you'll go bankrupt and you don't know why, and neither do they. And they're like, well, we grew your top line revenue. It's like you doubled the size of their revenue in 1 year, and they didn't have the working capital support. I'm talking like an accountant, but they don't have the working capital to support it, and you're going to be in trouble. So make sure that business coach understands that, the financial consequences of all these things. But that's the way you get through stage 2 and to the expansion phase.
Okay, so just to kind of summarize this. So we understand groundwork is you understand the importance of project budgeting and job costing, right? That's like the basics. You're saying don't even give me a call at apparatus if you're not budgeting. Okay, and then stage 2 is, I heard you say 2 things. Both, one, you start to get a grasp of overall accounting, which is the financial statements, so your income statement, balance sheet, and maybe cash flow statement, right? So you can kind of understand that. And then the second piece of it is you're starting to think about your you said financial controls. So your processes around keeping your books updated. That seems like a pretty high bar for stage 2. So I'm interested to hear what stage 3 is, and then stage 4, we get stage 4 coming too. So what is stage 3?
Here with questions. Yeah, keep going though.
All right. So I'll try to, I'll give you the high level of these last couple stages, and then I'll let you guys dig in. And I think you'll start to see, and Reece, I'm really interested to hear your experience as you grew up in building. And so, and Reece, I think if you went to start a construction company today with your background, I think you'd start in stage 3, right? So
I'm flattered. Don't pump my tires, Luke.
Yeah, it's either like a really high functioning operations manager would start in stage 3, or someone that grew up in the industry and went to, get their business degree at college, and then like they knew enough about their family company that like the things that the people are talking about in class, you're like, oh yeah, that's kind of how we do it. Oh, that's what that is. Like it's clicking with them as they're talking about it. And then, folks who've made it through stage 1, like, people that get really good coaching can just move on up the ladder. And if you're in stage 3, your focus is a couple different things. Like, one, you've probably delegated project level finances at this point, right? Like you're not a project manager in your own company. You have project managers. They're doing that. They're responsible for it. And the thing that you're probably focusing on the most is what is the pipeline of work that you have in place, right? So you know how much you need to sell that year to make everything work, and that's the number you're chasing, right? I would say that's someone in stage 3. You've delegated project level stuff. You're focused on the big picture. What do you need to sell that year to make it work? And that's what your focus is. And it starts to get kind of easier and harder at the same time, right? So you've been around enough. You've started to develop a gut feel for when things are going well and when they're not, right? And that can serve you. That's a two-edged sword, right? So you don't have to have a lot of formal knowledge for that to work. But if you're not checking it with real numbers, you can look up one day and you're out of money. You don't know how, right? And you all of a sudden you don't have what you need to like get the next round of billing cycle done, or whatever the case may be, right? And it's like that. It's the death by 1,000 paper cuts. And so having that gut feeling is really important. But if you're not fact checking it, you're exposing yourself to a lot of risk there. And so what we see is, or what I would do in that situation is, for your project managers, don't let them tell you that it's going fine and that everything's on track and that you've billed for everything that you're supposed to, and the budget, make sure that you're sitting down with the project managers that you've delegated that responsibility to every day, or every week rather, and you're fact checking this with real numbers that are coming from your accounting function of your business, right?
Mhm.
And that they're held accountable to those and have to explain those. And that's going to have a couple different impacts. One, it's going to keep your profit level where you think it's going to be, which means that number that you're trying to sell to is real still, right? Because if you start to make less money on every project, well, now you have to sell way more work to make up for it, right? And then also it's going to just help accuracy, right? Where your project manager, if they're really good at their job, they can probably get a little bit lazy, and they can probably not follow the processes correctly. And now all of a sudden you see that, you're over budget in this item because the framing contractor billed you for $10,000 more than the purchase order was for, which is the price you agreed upon in the first place, and like you have all this slippage that if you just had that conversation with the project manager once a week, that would have been caught the week that it happened. And you would have been like, hell no.
Yeah.
he's going to do it for the price he agreed to. And that's the end of it. And so that's a stage 3 guy to me. And if, they should have a business coach at this point, and one that understands real accounting. They should have a controller in-house, and they could outsource bookkeeping. They could, do whatever. And they definitely need a construction specific CFO, but that's stage 3 to me.
So okay. So it's starting to make sense. So the stage 1 is basically like job costing. Stage 2 combines job costing with accounting. Now you have this and the financial controls. So now what do you have? You have accurate information, right? And it should be pretty real time as well,
Yeah.
because you got the good processes in place. And then so stage 3 is like taking advantage of understanding this real time information, and you're starting to act on it. Is that kind of how you just? Is that fair?
That's why you'd call it the expansion phase, right? So now you've got this toolbox, and you're going to start using the tools to build the business, and you're growing, right? You're doing it.
Yep.
So I get you.
And so back to Reece's question earlier, which I think the audience cares about, right? Is what size is that, right? So how many jobs can one project manager handle?
That's a great question. It changes. It changes all the time. It depends on the project manager. It depends on, if you're doing custom cost build work like dream home for people, you probably don't want your project manager on more than a couple projects, maybe 3, right? If they're doing tenant improvements, then a lot more. I heard I heard early on in my career, I was like taking project management classes, and the guy who was teaching, someone asked us like, how many projects can a project manager handle, and he was like, no more than 11. And some guy was like, I do 13. And he's like, that's great for you. He's like, let's look at it this way. Jesus managed 12, and one of them didn't go so well. So
yeah, that is good. Yeah.
Well,
okay. But yeah. So okay. So you start to have PMs, and you trust them to manage the financials and keep on top of stuff, and you have someone else in the back office giving the accounting, and it's your job to understand it and act on it. That's expansion, right?
Yep, that's right.
And then before we get there, so really, and even again for the audience, and the reason I say this is because I see, like, based on even who we talk to, who I've talked to in my past career, like, they could be a $10 million a year builder and not be running QuickBooks, right? So that would technically like put them in like the groundwork phase, right? Yeah. So I think it's really more of like a mental delineation and comprehension of what's actually happening. And I've said this multiple times, but when you do, I mean, it really does take like a sincere commitment to business, not just the product that you're creating, which could be beautiful, it could be incredible, it could be the top in the market, but it really, like, what I'm picking up on is it's a commitment to business to then start identifying, this is what I'm doing it well consistently. Next, I need to get this framework piece in place, start really focusing on the efficiency side of what we've been doing. And then we get into the scale, and now we're in the 4th phase.
Right. Yeah. And I would say to get from the 3rd phase, like to your point there, Reece, and I should have mentioned this, to get from the 3rd phase to the 4th phase, one of the really key aspects of that is, I mean, you guys, I'm sure, have read the E-Myth, right? I hope all of your listeners have read the E-Myth. If you haven't,
very popular.
Like, go get it right now. There's one for construction companies specifically. But this is that process of the project manager who is a technician becoming a business owner, right?
Mhm.
And which is a very, very different skill set. You may be doing a lot of the same things, but it's a very different skill set. And so when you get to the third phase, the only way that you're going to either stay there or move out to the fourth phase is that you have to understand that you are responsible for managing the finances of your company, and you have to set aside time to do it well, and you have to be looking for resources on how to do it better all the time, right? And that's who you're going to see in the fourth phase are people that understood that they got to the fourth phase, which is strategic growth. I think we called it, strategic mastery,
Yes.
and they're going to have they've learned something about business finance. You will not get there without understanding business finance, and we've seen, at Apparatus, like we've dealt with a whole bunch of different types of customers. We've had some guys that were operations manager who, like, they're a CPA, but they're an operations manager at a construction company, right?
Yeah.
And they're bringing us in to help them out. So you had to have some point where you learned about this. Maybe you got your MBA in finance, whatever. And it could be people that made it through stage one. It could be people that were really high up in the industry. It could also be people who, I think one thing we've seen is people that went in, they were that project manager. They started a company, they got to stage 1 or 2, and then they got beat up pretty bad. And then they're like, I'm out. I'm not going to go work for somebody else. They did. They figured out where they went wrong. They figured out that they needed to learn finance. They made a commitment to that. They did it. And now they're ready to do it the right way, right? And so we see people actually, I mean, we've had a client recently who I would say has every indication that they're starting in stage 4, right? And that would be
Very
my
cool.
They've done it before. They've gotten beaten up. They've gone to work for other people. They figured out the right way to do it, and now they're back to do it the right way. And these people, I think the key part about this, like, it's like that, knowing what you know, knowing what you don't know. Like, they understand that they have blind spots, and so they're always trying to figure out what those are. And I think you'll see that in it's not just an accounting aspect of their business, right? It's every aspect of the business. They're doing this. They're reading everything they can get their hands on. They have business coaches that, maybe multiple business coaches, or maybe they've been through a couple. Like, they're really trying to understand how to do every aspect of their job really well. And they're always trying to get more information on how to do that. And these folks have, they've kind of gotten through it all. And I would say they don't have, because of their dedication to learning, they really don't have as many blind spots. Like, that's not something that really exists in the same way that it does the other stages. But they do have, at this stage of maturity, their risks are more structural to the economy, right? So let's say that someone in stage 4 is someone that's doing 30 spec homes a year. His risk, if they increase mortgage rates by 2 or 3 points, now he can't sell those homes for as much as he would have been able to earlier. He has his overhead to hit. He has all these numbers. So he's dealing with the risk for him are coming from, or her, are coming from larger economic forces. It could be regional downturns. It could be, even competitors. Like, I think you're at the size at that point where a competitor taking 20% of your market share could threaten your business, right?
Yeah.
And so,
but Luke, can we? So I understand that, but can you clarify a little bit? So I'm struggling to understand the difference between 3 and 4 a little bit, because I understood 1 and 2, and then the jump to 3 is you have the information, you know what to do with it. It seemed like 4 kind of blends into that. Can you give us a kind of tangible example of what's different between 3 and 4?
Yeah.
Like what is the increased knowledge you would gain between 3 and 4?
So I think that the key focus for people in stage 3 are going to be that pipeline, right? They know how much they need to sell to get to the end goal, right? Stage 4, the biggest delineation I would say is that stage 3 people, they in their head, they're valuing their business based off their profit and loss statement. How much they sold or made at the end of the year is how they consider the financial health of their business. Stage 4 people are looking at their balance sheet and they're saying, what is the tangible value of my business at this point, and what is it at this point? Am I growing my assets, and am I shrinking my liabilities? And is my business getting more valuable? And so that's the big difference. So we have people that come in, they're like, we're focused on the balance sheet. We're trying to build something valuable. And that's the big difference, because you can have a profitable business, you can have a profitable P&L, and at the end of the day, you can be slowly taking away value from your business. And so that balance sheet is getting, your business is becoming less and less valuable tangibly in that same time frame. And then eventually it's going to catch up with you, and you're out of business. And so the stage 4 folks, they understand that they're not just focused on the pipeline. Maybe that's even delegated at this point, right? They have a sales manager whose role is to sell X amount of dollars, right? Then that could change based on what's going to happen at the last 3 houses, or what's going to happen in the interest rates, or whatever, right? And so that's going to be something that's a delegated responsibility. And then they are looking at what is their working capital, so making sure that they are liquid enough, that they have enough cash on hand between all the different places that cash hides in companies, that they're going to be able to do the things that they need to do and pursue the goals that they need to pursue. And then they're focused on the value of their business being something they determine from the balance sheet. And so, like, if you're driving your business by the balance sheet, I would say you're in stage 4.
Got it. What do you think, Dr. Dollar? Was that sufficient? Was that a sufficient answer?
Yeah, no, I mean, I think so on the balance sheet point, I think it would be helpful to, I mean, I guess a lot of the audience maybe won't necessarily be in stage 4. What is an example where this, you're building profit every year, but you're deteriorating value? How would that happen?
Yeah. So not every transaction goes on your profit and loss statement. We talked about that, and that was like a stage 2 problem, right? Where you're trying to equate what's happening in your bank account to what's happening on your profit and loss. And so what can happen is that you are profitable, but you took 3 vacations to Tahiti, and those don't, like, you took money out of the company every time you did it. Those don't hit the profit and loss statement. You have a profitable company. Did you suck all of the profit out of it by taking owner's draws? That's stuff that's not hitting the profit and loss statement. Are you, buying a bunch of equipment, or vehicle? Like, are you looking at a profitable construction company, and you're building the woodworking shop you've always wanted, and all of that's going to the balance, or most of that's at least going to the balance sheet, and it's not on the profit and loss statement. So you're looking at, the stage 3 person's looking at that profit and loss statement and say, I'm profitable. The stage 4 person is very conscious of what the value of their business is. It's including things like all the vehicles you own, you have. It's including the loans that you took out. It's including,
Okay.
all of that stuff.
Okay, got it. Yeah. So based on this, it sounds like just to restate these 4 stages is, stage 1 is you understand job level profitability, right? So
Yep.
that's stage 1. Stage 2 is you're starting to think about company level profitability, right? So you at least have the systems in place to track company level profitability. What is company level profitability? It's job level profitability plus overhead. So now you have that information, right? And you have put the systems in place to have the information. Stage 3 is you're acting on that information. So you're like, okay, this year I want to do this much company level profitability. This is my overhead. These are how many jobs I need to sell. And then you're describing stage 4 as like, I'm thinking about the balance sheet. I understand the balance sheet. The balance sheet is the value of my company, building every year, right? If I add 100 grand of profit this year and it goes to I don't want to get too technical on the balance sheet, but it goes to like the retained earnings, and I'm starting to build equity in my company over time. You're just basically adopting more of a kind of like a balance sheet or a long-term oriented view of the value of your business. It's kind of how you describe it, right? So it's like P&L up until stage 3, and then everything else stage 4 beyond. Is that right?
Well, and even to dumb it down to Reece level here, is my understanding of this is from like 3 to 4 is like it's stage 3 is like recognizing that you have profit. You start to understand the P&L. But then the stage 4 guys being more strategic with how they use that profit, whether they are investing in assets that are going to increase the value of their company instead of saying, I am a profitable company. I worked my ass off for this. Let's go buy a boat, to quote Zach Kelly, right?
Yeah.
These are things that they're looking at and they're like, I've got a longer term vision here. I understand I have assets, I have liabilities, I have equity, right? Asset, liability, equities. And then you start looking at all this math like, well, there's more.
No, that's right. You're describing it better than I was. I was actually just thinking as you.
Well, this is what I do for a living, Matt. Let me wrap this up for you. Put a little bow on top for everybody. It's a strategic use of your profit from your business, and all for like the long term growth of it. I think the one piece too is interesting, and I know we are getting a little close on time here, and it's hard to put like a revenue volume to it or like, are you ready? It's really like that mental conscious maturity, financial maturity of going through these stages. But do you have to go through these stages? Why not just pecker out at framework and just build a 20-year business in the framework stage? Or can you? Or if you get to the strategic mastery, now you're like opening up a whole can of worms, and you're like call it a production builder. You're doing volume builds. You're hitting 40, 50 million in a certain area. Now you're starting to probably get metropolitan areas where you're competing with like the Lennars and the DR Hortons, and like you're in this like constant wheel. Like, where do you call it good?
So that's what's funny is you can see stage 4 guys doing $6 million a year.
Bang. Okay. That makes sense.
And a lot of times, like I would even say they're like, no, I'm not gonna do that. I can do this. It's super chill. I don't have to get stressed out. I'm just gonna drive the same truck I've been driving, and things are good. And I'm slowly growing my business to be, I don't have to worry. I don't have to, stay up at night wondering how we're gonna make the next, AP cycle, whatever. They're just like, everything's fine.
Well, and I think that's probably like, okay, this was all great content, but I think that is probably the biggest light bulb moment for me is like breaking that association of success and revenue, right? I think so many people look at them like, I want to be a $10 million a year builder. It's like, why? You go run out and grab $10 million of top line revenue until you're blue in the face, but you're going to be making the same revenue you were at 5. Like, what does it have to do there? I think that's what a lot of guys kind of get in that, like, keep up with the Joneses, like, whatever it is you want to consider it. But I think focusing on yourself and really, like, running or growing a healthy, scalable business that's focusing long-term. What is this asset, which is what a business is, doing for me? And then you have the framework to scale. Interesting.
Yeah. And we'll even see stage 3 guys chasing that top-line revenue because they need to say at the country club that how much volume they did the previous year. And then they'll get into stage 4 and they figure out where the value of their business actually is and what that means to them and their family. And then they're like, oh, I'm going to spend 2 more days a week at the golf course.
Yeah. I guess this has been an interesting discussion. I guess the way I'm kind of thinking about your stages now is like, hey, I think about stage 1 is I'm at least thinking about one project at a time, right? So how's this current project performing as it's happening? Stage 2 is I'm thinking about projects combined with overhead as they're happening. So again, the keyword is as they're happening. Stage 3 is I'm thinking about them this year, right? So you said pipeline, like forecasting this year. So I'm starting to think about overhead plus projects combined, and I'm thinking about a year out from now and what's my profit going to be. And then stage 4 is I'm thinking 5 years down the road. And this is maybe not the best example, but one simple example I thought of in terms of your comment on how do you build value in a construction business over the long run. One of the most enduring ways to build value, right, is through your brand, through your reputation in the market, right? So this is a bad example. I've never seen a customer do this, but maybe a good example is, hey, I really want to build my brand so that in 5 years I have leads flowing in, right? One way I could do that, I'll hire like a dedicated customer hospitality manager who calls customers all the time and is like the person that checks in and they can vent to them about how the job's progressing and make sure all their concerns are addressed. You hire that person, your profit this year is going to go down immediately, right? Because they're not immediately generating any value. But in the long run, if these customers have a great experience and your brand builds and you have all this value, then your company is going to be worth a lot more in the long run. So I guess that would be a way when you're starting to think your strategic mastery. I think it's worth this investment to take a hit on my profit now for the long-term value it generates. Is that a good example? You think that's fair?
I think that works absolutely. I mean, another way to do that, like to me, like the easiest way to get control over your brand is to not grow so dang fast, right? Like have some very moderate, unsexy growth rate, but you're doing it really well. And you make sure you can grow at a rate where you do it really well. And now all of a sudden you have control over your brand too. And so Matt, to your point, you're still sacrificing short-term profitability, but what you're gaining in the long run is a lot better.
Yeah. That makes sense. Yeah. I mean, it's kind of, Reece, remember podcast 2 with Cal where she talked about, she talked about she was faced with the decision. They had left the corporate world and paired up with a GC who had taken on a bunch of projects that they hadn't realized when they initially paired up with him, but after the fact were going to be extremely unprofitable. And they decided to, instead of walking away, because they felt like their kind of personal reputation was tied in with his now, they decided to personally cover the losses on those projects, which obviously takes a huge hit on their profitability this year. But then in the future, the return is, well, they're going to tell their friends about us. We're people of our word, right? We stick with you. We stick with the customer, put the customer first. And now the business is doing much better. So this is an example of, I guess, strategic mastery.
Yeah, that's one worth listening to, Luke. I mean, that's a pretty extreme example, but it's exactly what you're explaining as a stage 4 consumer. And these are people with like exceptional backgrounds in Fortune 500 companies and executive leadership. So it makes sense. But when you hear that episode and you're like, those are big numbers just to personally cover, all with that long-term vision, and then it shakes out.
Yeah.
That's a big bet, but
it is. Well, also they can afford to make that bet because they have the value in their company to do it. Right. Mm-hmm. And so that's, I think, one thing, like people get into the situation where it's like, even if they want to do that, it's not necessarily, no guarantee that you can.
Yeah.
Cool.
But no, I think this was a great episode. A wealth of knowledge you are, Luke Holcomb. If anybody wants to, get some of this knowledge, head on over to Apparatus, go through the cycle, cut a check, and you can talk to the man.
Cut a check and you can talk to me.
Right. That's right.
One thing, we did want to offer something to the folks listening to your podcast here.
Yeah.
If we do a book review, right? But we'll look at your finances. We'll tell you what you're doing right, what you're doing wrong, what we would change about it, right? Because people, sometimes they have someone in house that's like kind of doing a decent job, or they don't know how they're doing and they want to figure it out. We offered that. If any of your listeners want to take advantage of that, we'll give it to you for 50% off.
Oh.
You just have to type in the discount code adaptive.
Let's go. First promo code.
There we go.
Okay, recap. 50% off, promo code adaptive for free consultation or half off consultation.
Books review.
Where do they go? What do they go to? Apparatus.com or what?
Apparatusteam.com is our website. I can give you guys a link to the
We'll post all this.
Show notes, whatever.
Yeah.
Okay.
No, that's great. And this is actually, and Matt's going to kill me for this, but this is the one, you made a comment earlier about construction-centric accounting and the importance of it. I think it was in stage 2.
Yeah.
just a quick little rifle off, give like 30 seconds. And then, because that's all applicable to what you guys do at Apparatus. Why you as opposed to your wife, your so-and-so, right? That has no idea. They can do the books. They might be doing them, but they don't have that construction-centric accounting.
Yeah, construction-centric accounting is one. It's some of the most complex contracts to manage financially that I know of, and then there's so much money moving so many different places that it's so easy to get in trouble, right? So if you, a really quick example, let's say you get a $30,000 deposit on your next project. If you go look at your P&L and you don't know what you're doing, you don't know how to book that correctly, it all of a sudden looks like you made $30,000 more than you're actually making in real life because there's no cost to offset that. It's because it should be on the balance sheet. It's like there's all these things, right? And find somebody that knows what they're doing.
Which you can at apparatusteam.com. So appreciate you, Luke. This was a killer episode. I'm super excited to get this one out. We'll let you get to it, but thanks for jumping on, dude.
All right. Thanks, guys. It's good to see you.
Appreciate it. See ya.